Hi, my name is Paul and welcome to month number 3 of my Wealthsimple $100 per month Canadian stock portfolio. This month I'll be going over the annual earnings reports and conference calls for the Morguard North American Residential REIT as well as MTY Food Group. I'll also be covering how the portfolio performed over the last month with comparisons against benchmarks including the S&P 500. And as always, I'll be showing you exactly how I'm going to be investing this month's $100. But before getting into the earnings information, I'm going to quickly go over the goals and rules for anyone who's new to the series. So if you want to skip ahead to the earnings breakdown or the portfolio's performance, then feel free to do so using the timestamps in the description of the video. Alright, so with this portfolio, I had $100 every month. I can't add more and I also can't add less. All the trades that I make in this portfolio must be placed on a single trading day each month, and only securities trading on Canadian exchanges can be purchased within the portfolio. Derivatives are completely off limits, and I can only buy or sell companies with a market cap of over $300 million. The reason I put these rules in place is to try and emulate the circumstances that are limiting to many aspiring Canadian investors. With this series, I hope to show people that even under challenging limitations, you can still reach your financial goals so long as you take the first step and get started. And the sooner you do so, the better off you're setting yourself up to be in the future. Also, I have a personal goal with this portfolio, which is to achieve a compounded 12% annual rate of return or more. This is because I put a lot of time and effort into doing research into different businesses, and I believe that a 12% rate of return will be the minimum compensation that would be worth the extra time and effort that I put in to investing. If you're someone who wants to get started investing in businesses for your future, but you don't want to do the extra research work, you can still do so and get good returns by regularly investing into broadly diversified ETFs, which have historically performed much better than savings accounts and GICs over a very long period of time. So you don't need to let your lack of investing interest or knowledge stop you from achieving your financial goals. Also, if you want to see the portfolio rules and goals in more detail, there's a link in the description to a document with everything that you need to know about the rules and goals of this monthly portfolio series. Alright, and with that out of the way, let's quickly go over a brief recap of the companies that I hold in the portfolio. The largest position in the portfolio is, of course, the Morguard North American Residential REIT, ticker symbol MRG.UN on the TSX, which is one of 3 Morguards traded on the exchange, so make sure that you're looking at the North American Residential REIT and not one of the other Morguards. Morguard owns apartment units within cities and large suburbs throughout the US and Canada. Last month, I again invested over 70% of the monthly $100 into Morguard, because Morguard is currently the company that I have the most conviction in. The investment hypothesis here is that the business is trading at a massive discount compared to its peers, based on the price to tangible book value and the price to funds from operations. MRG also trades at an even greater discount to the actual market value of similar units in the real estate market. The second company that I've been buying in the account is Knight Therapeutics, ticker symbol GUD on the Toronto Stock Exchange. Knight is a pharmaceuticals company that is based in Canada but operates mainly throughout Latin American countries by licensing, marketing, and distributing generic and innovative drugs. Last month, I invested around $11 of the $100 into Knight. Knight is a company that, despite having some additional risks, has a larger potential reward catalyst with a risk factor that I believe is low relative to the company's valuation. This catalyst involves loans to biopharmaceutical companies that allow Knight exclusive rights to purchase successful product developments created by borrowing companies. Knight's business also has a high-quality management team with a history of proven success utilizing the same business model in the United States under Paladin Labs. This business model is centered around making acquisitions of underpromoted and older drugs that can be marketed and distributed profitably without requiring significant capital expenditures. Even if the potential catalyst scenario doesn't play out, Knight still has strong growth coming from recent acquisitions that somewhat obscure the fair value of the stock, which I believe should be at a minimum of 30% higher than the current share price. The final and most recent stock added to the portfolio was MTY Food Group, ticker symbol MTY on the TSX. MTY's business is comprised of franchising and operating restaurants and retail food product sales and distribution, mostly within the US and Canada, though the company does have small but growing international operations. Last month, I spent $16.92 out of the $100 as well as the remaining few dollars in the account that wasn't invested during the previous month on fractional shares of MTY. Even though MTY's many brands, like Taco Time, Papa Murphy's, and Cold Stone Creamery, aren't leaders within their niche, the company's focus on highly profitable acquisitions under the guidance of founder Stanley Ma has led to some of the fastest long-term earnings growth in the entire restaurant industry. Additionally, the company trades at a noticeable discount to even the slower growing of its competitors within the industry. And like Knight Therapeutics, with this company, I believe there's also a hidden growth catalyst, in this case coming in the form of bundled service subscriptions on delivery apps like Uber Pass, which I believe is likely to benefit companies like MTY that own multiple different brands that operate within a variety of different restaurant niches. Also, MTY's strategy of moving towards creating branded retail products from its top performing restaurant brands should add a more stable source of income during times of hardship. I believe that this newer growing business segment will be able to offset some recession and debt-related risks that could otherwise have a significant negative impact on the business. So that's my summary of the 3 positions held within the portfolio. But if you want a more in-depth breakdown of the Morguard, Knight, or MTY investments, then I recommend that you check the video description and click on the link to the monthly portfolio playlist, which contains all the episodes in the series in order. The first episode in the playlist has my analysis on Morguard and Knight, and the second one has my analysis of MTY Food Group. Let's get into the earnings reports and the general news that's occurred over the last month. So first, we're going to take a look at Morguard. For me, the most important thing to come out of the numbers released by the REIT was that the tangible book value per share increased by $2.62 in the quarter. Over the same period of time, MRG's share price increased by only a little over $1, or roughly 5.5%, meaning that the company's property value continues to be heavily discounted. So even though the share price has gone up, the value of the REIT's shares have actually gotten cheaper. This growth on the balance sheet came despite a reduction in the net operating income on the Canadian side of the business, which was of course down due to the lockdowns within the quarter affecting people's ability to search for apartments and causing about a 1% lower occupancy compared to the previous year. This, however, was partially offset by the increase in average monthly rent that was only allowed because of the tenancy turnover. Because in Ontario, there's still a COVID-related freeze on increasing active tenants' rent, which was implemented by the government in order to protect renters during the pandemic. During the conference call, it was expected that the current lower Canadian occupancy rates will likely start to turn around over the coming year as the Canadian border begins to allow immigration and students who help to contribute to rental unit demand. Also, the country's pandemic-related regulations are expected to return to normal over the coming year, which should also boost occupancy and average monthly rent per unit. Shortly after mentioning all this on the call, it was noted that this guidance does assume that the risks related to COVID and monetary inflation are mitigated and that the removal of emergency-level monetary support from the Bank of Canada, expected to happen later in 2022 at some point, doesn't significantly affect rent payments. On the other side of the border, the larger US property holdings also had a slight reduction due mostly to foreign currency exchange losses. But the rest of the numbers on the US side were nothing but good news, with occupancy increasing about 4% throughout the year and the average monthly rent per unit increasing by almost $100 year over year, with some properties located in the Sunbelt and coastal metro areas increasing AMR by over 20% on the year. Also, the Louisiana property, which was undergoing redevelopment, just achieved stabilized occupancy in the quarter for the first time since completing renovations, which helped to offset foreign exchange losses and should continue to contribute positively to net operating income going forward. Also noted in guidance was that projections of economic growth throughout 2022 is expected to support stronger labor market conditions, which should in turn improve rental demand. Some other mentions that I thought were of note during the call were that Canada's real estate market is apparently much more expensive when considering potential property investments than the US. So currently the company's looking towards the US where property prices, while still high, are more reasonable. Another piece of information that was briefly mentioned during the Q&A segment of the call was that the REIT is currently considering taking profits on a property in the Sunbelt region of the United States, and that there likely won't be any dividend increases this quarter, though they may raise the distribution next quarter assuming they can't find a good target for acquisition. Personally, I got the impression that the REIT is more focused on acquiring a new property than anything else and probably won't end up selling any properties unless a better opportunity comes along. So overall, a pretty average release from Morguard, but considering the discount to tangible book value, they can afford to have a mediocre performance and still provide significant market-beating returns. That said, once the COVID-related issues start to go away, I think Morguard will start getting harder to ignore going forwards. Anyways, as for the dividend, the REIT did pay out their monthly 5.83-cent distribution per share on February 25th, 2022, and they announced that they'll be paying another distribution in the exact same amount on March 15th. And we've already passed the ex-dividend date, which was on the 28th. And with that, we have gone through all of the important news from Morguard over the past month. So let's move on to MTY, who also announced their annual results over the past month on the 17th of February. First, let's get to the bad news. Over the quarter, MTY had net closures of 129 restaurants throughout the world, and the pandemic-related lockdowns in Canada towards the end of the quarter did somewhat lower results, as did the other challenges like supply chain issues and labor shortages, which will likely continue going forward. MTY did address this in the conference call, and they said that they're going to be combating these issues by streamlining their business through working directly with suppliers, increasing prices, and enhancing training for workers. Pretty much everything else was good news though. So despite the issues faced by the company, revenues were up 15% from Q4 in the prior year, and full year revenues were up 8%, which was driven mostly by top brands which outperformed expectations, as well as mobile and online ordering. Now, if you want to go through the document that I'm showing here, this is the Management Discussion and Analysis Report, or MD&A report, that requires you to go to the CEDAR website where the documents are filed. This is because MTY only offers the full year results on their website, which does not have any quarterly numbers in it, though they should be coming out with the fancy annual report like last year sometime in the future, which will have all the numbers and pictures to go along with them. Anyway, franchising revenue growth in Canada was heavily impacted by continuing COVID-related regulations, but US franchising was up 10% for the full year, and the food processing, distribution, and retail segment of the business grew by 20% in Canada and 9% in the United States, which was again for the full year. As for quarterly numbers, food processing, retail, and distribution revenue growth was exceptional, hitting 40% in Canada and 18% in the US. Q4 franchise growth in Canada came in partially high just because of standard business growth, but also because these numbers are being compared against Q4 2020, which occurred during heavier lockdowns and regulations. The States, on the other hand, saw a slight decrease in franchising revenue, which was caused almost entirely by foreign currency exchange conversions being a little bit negative. Now, if you happen to notice the 15% drop in corporate stores revenue growth in the US, this actually didn't have anything to do with business performance, but it was caused instead by a sale of multiple corporately owned Papa Murphy's locations, just to free up capital, I'm assuming. It didn't really say in the report. Anyways, net income per diluted share was up 25% over the same quarter last year, and full numbers wouldn't really make sense to compare since MTY saw a net loss in 2020 due to lockdowns, but when we compare it to 2019 numbers, the company actually saw an increase of about 12%, which is pretty good considering there was no lockdowns in 2019 and 2021, still a bit of recovery happening. Moving to free cash flow per diluted share, the company was actually down about 20% when comparing Q4 of this year to last year, and this wasn't really explained in the conference call or in the MD&A, but the full year free cash flow per diluted share was still 20% higher than in 2019. So for now, I'll just chalk this up to variance, since it could be any number of things that are negatively affecting this Q4 or possibly even positively affected last Q4. Maybe they'll address it in the fancier annual report that they'll release later, but in last year's annual report, they also didn't really have any comments on the changes to free cash flows, so I wouldn't really expect too much. Either way, we did get an accounting of where some of this free cash flow was spent, and firstly, the company raised the dividend by 14% to 21 cents per share. Then they repurchased for cancellation $2.2 million worth in shares, and the company paid off $22.7 million of debt in the quarter, making it $102.4 million in debt paid down throughout 2021. Now on to some of the key takeaways that I took from the conference call. The first of which was that going forward, there will be some issues with supply chains and labor shortages, but the company is planning to open several new and old franchises in 2022. The company also guided for more growth, assuming pandemic restrictions start to die down and things start getting back to normal. This growth is also expected to be led by the retail product segment of the business, and I do have a bit of an update on that front for you later on in the video. Also mentioned in the call was that the company is considering a substantial dividend increase, and they're considering repurchasing more shares. However, the priority, again, is on aggressively pursuing high-quality potential acquisitions. Finally, the CEO said that the company will be focusing heavily on investing into more digital and online ordering, which is largely untapped in Canada. Apparently, 1/3 of orders come from third-party apps like Uber Eats and Skip the Dishes, while 2/3 come from their own platform within the US. This, however, is almost opposite in Canada, and because the business has higher margins when they don't have to pay third parties, the company is going to be focusing on investing more into growing out their own platforms. And this was one spot in the call where I actually somewhat disagreed with the management's decision here. I think it would be better to strike some sort of deal that would allow MTY's brands to show up higher in search results on the apps. Now, this is obviously assuming that the giants in the industry like Burger King, McDonald's, Taco Bell, KFC aren't already doing this, and that the apps would be willing to adjust SEO ranking in MTY's favor for money. But if MTY could get a couple of its brands to show up above some of these bigger industry competitors, they'd probably manage to steal a little bit of market share, and over time that will probably hit the bottom line. For instance, if Taco Time starts showing up ahead of Taco Bell, Chipotle, and Del Taco when people search for Mexican fast food, I think that people who otherwise probably wouldn't scroll down to find the chain in the first place would probably give the brand a shot and might end up trying something that they like enough to keep them coming back every now and then for years to come. Basically, this idea can be broken down into the Shark Tank meme of it's better to own 10% of a watermelon than 100% of a grape, except instead of ownership, I'm talking about net margins. But again, it could easily be possible that the giants of industry have already hopped on paying way more than MTY can ever hope to budget in order to maintain their top spots. And if so, then they're probably doing the right thing in trying to boost their own margins. But that's my 2 cents on what I think they should be doing. For the most part, earnings with MTY were decent, and it sounds like there will be a lot of positives to look forward to in the next few quarters. As for Knight Therapeutics, literally no news in the quarter, so let's move on to stock portfolio and performance. Starting with Morguard, I purchased shares at the beginning of last month for $18.55, and over the month these shares have risen a total of 5.12%, up to exactly $19.50 per share. When we add in the dividend of 5.83 cents per share that Morguard paid out, this boosts Morguard's gain up to 5.44% over the month. Also, we passed Morguard's ex-dividend date and can expect an additional 5.83 cents per share next month. Next up is Knight Therapeutics, of which shares were purchased at $5.54. Over the month, the share price came down by about 2.53%, ending the month at $5.40 per share, and Knight does not pay a dividend. Last, and in this case least, was MTY, which began the month at a share price of $55.06 and ended the month down 9.99% for a closing price of $49.56. In the month, MTY did pay a dividend of 21 cents per share, but the ex-dividend date was 1 day before I purchased MTY's shares, so we didn't get any. What can you do? We'll get it next quarter. Despite the massive 10% drop in MTY's share price over the last month, the $102.20 allocation of capital last month did see a gain of 2.02% in the month, thanks to the much larger capital investment into Morguard's shares than the other two companies. Currently, the portfolio sits at $209.26 on invested capital of $200, putting the total portfolio gain over the 2 months since inception at 4.63%, which honestly is kind of surprising considering it's been a tough month for the markets and the world at large for that matter. Comparing these gains against the 4 ETF benchmarks set last month, the public portfolio's investments have once again outperformed the S&P 500 index, VFV, which lagged by about 4.34%. The public portfolio also outpaced the rest of the benchmarks in the ETF this month, beating the Global Value ETF with the ticker symbol VVL, which fell behind by 2.92%, as well as beating out the Canadian Large Cap ETF, ticker symbol VCE, and the Canadian All Cap ETF, ticker symbol VCN, which trailed 1.52% and 1.23% respectively. Since inception, which again has only been 2 months, if I'd invested $200 into each of these indexes as well as my own portfolio, the results would be as follows. The S&P portfolio would be worth $191.15, representing a 4.47% loss. The Global Value portfolio would be worth $196.48, representing a loss of 2.12%. The Canadian Large Cap portfolio would be worth $201.26, representing a gain of 0.68%, and the Canadian All Cap portfolio would be worth $201.66, representing a gain of 0.97%. My public portfolio, on the other hand, currently has a balance of $209.26, giving it a 4.63% gain. This means that the ETF benchmarks set would have trailed my portfolio during the 2-month time period by a range of 3.63% to 8.66%. Again, it's only been a 2-month period, and this early outperformance can pretty easily be attributed to variance, so don't go expecting continuous outperformance of this magnitude, as nice as it would be to have that happen. Alright, coming to you on Friday, it is now time to decide on how to go about investing this month's $100, which I have just deposited last night, as well as the 23 cents in dividends courtesy of Morguard. Now, there aren't any new companies I'm looking to add in the portfolio at the moment, and for the most part, I'm probably just going to invest the same way I did last month. Morguard's tangible book value per share increased over the quarter by $2.62, which is 40% less than the actual share price has moved over the same time period. So this stock has gotten even cheaper based on the valuation of its properties over the quarter, which is why I don't mind spending nearly 78% of this month's capital on purchasing 4 more shares of Morguard. This should leave roughly $22.23 left in the account in order to buy 2 shares of Knight for a total of about $10.70 and a fraction of a share of MTY worth about $11.53. I'll also mention here that after the 10% drop and the good earnings prospects from MTY going forwards, I'd probably consider it a slightly better investment for the money at the moment than Knight Therapeutics. But with that said, let's cut forward in time and see what we get the shares for. Okay, so as you can see, we have $100.23 that we have to spend. So let's start out by buying our 4 shares of Morguard. So 4 shares, market buy. Let's see what exactly that comes out to. It seems like we're going to get it for about $19.36, which is a little bit higher than I projected yesterday, but that's what happens when the stock price goes up just a touch. Should be fine. Let's buy, next, continue, confirm. Let's make sure that that went through. And it looks like it did complete, and we got 4 shares for an average price of $19.63. So exactly as it said. Now let's go back in. We have $21.71. So we should still be able to buy everything that we want here. We can do 2 shares of that. It looks like we'll get it for $5.42 on average. So let's go ahead and buy that. Confirm. Make sure that it came in for an average of $5.42. So we got both our shares of that. And then the last thing that we want to do is use this $10.87 to buy up the last little bit of MTY shares. $10.87. And we should be able to get about 0.2204 shares, but I'll have to come back to you guys later once it goes through, which usually takes till the end of the day. Yeah, this order will be filled at the end of the trading day. So that's fine. We'll confirm that for now. Did it fill? No, pending. All right, so it's just a little bit after 3 o'clock, and I just received a confirmation email that the fractional buy order for MTY has been filled, and it looks like I received 0.2212 shares for $10.87, making an average price per share of $49.14. So I'll cut it here and update the spreadsheet, and I'll see you back right now. But before I get into the updated spreadsheet, I want to first update you guys on the email I sent to MTY last month. Unfortunately, I never got a response back, but I did decide to do a little bit of research, which turned into a full-blown investigation on every single brand that the company owns. I found a lot of interesting information, but considering that there was already earnings to cover this month and MTY's retail products are a bit off topic for a monthly portfolio video, I decided to just go ahead and create a separate video on that topic. This video will, however, be coming out after I put out a different video on my top 7 stocks trading on the TSX, which is a long project that I've been working on for quite a while, and it's almost done. So don't think I've forgotten about MTY's retail products. I'll be covering them in the near future. Anyways, let's take a look at the updated spreadsheet so that we can better see what the portfolio currently looks like after investing this month's capital. So as of market close on Friday the 4th, the portfolio holds 12 Morguard shares worth $236.28, making up 75.98% of the portfolio. The second largest position is made up of 9 shares of Knight Therapeutics worth $48.33 for a total of 15.69% of the portfolio. And finally, I have a bit over half a share of MTY valued at $27.79, making up the remaining 8.34% of the portfolio, leaving me with no cash left over, which is exactly where I want to be at this point in the portfolio. Also, starting this month, I'll be tracking dividends received as well as calculating annual dividend income based on the current holdings. Over the last month, the account received its first distribution on 4 shares of Morguard, coming in at a meager 23 cents. But I've also passed the ex-dividend date for Morguard's next distribution, and this time we have 8 shares. So the portfolio will receive an additional 47 cents over the coming month for a cumulative total of 70 cents collected. And next month, even more shares will qualify for dividends at the ex-dividend date. Now, I know that the dividend income seems like almost nothing right now, but over time you'll get to see it really grow substantially, and I think that when we look back on it in 1 year, 2 years, 5 years, it's really going to show like how far the account has come and how compounding really starts to stack up. Moving on to the last part of the dividend sheet, I've also calculated the current annual yield of each company's dividend and the yield on cost. So over the period, if I hold 12 shares of Morguard, which pays a monthly distribution of 5.83 cents per share, I can expect to earn roughly $8.40 on an annual basis from Morguard. Based on the cost that I paid for these 12 shares, this comes out to a yield on cost of about 3.75% for the company. MTY Food Group also pays a dividend to its shareholders, which, when accounted for, boosts the annual yield for the full portfolio up to $8.84 on the book price of $300.23. By taking the annual yield and dividing it by the cost paid for all the shares within the portfolio, we'll see that the total dividend yield on the cost of the entire portfolio is 2.94%. Personally, I don't really have a target that I'm trying to hit with regards to dividends or portfolio yield. As long as I continue to reinvest in dividend yielding companies, the only thing that I'm really looking to see happen is a general increase to my annual dividend yield over the long run. That said, if one of my companies has an opportunity to substantially increase income over the long run, but it requires them to cut their dividend, then I'm not going to be upset that my yield has been decreased over the short term, assuming, of course, that the opportunity looks reasonable. If one of my companies bets big on something that I think is a waste of capital, I'll be looking into my own new opportunities before Wealthsimple can fill the sell order. But that's why I look for good management teams. That way I don't have to worry too much about how the business is making its investment decisions, because I know that they're probably going to be doing the best that they can. On that note, that's pretty well all I have planned for the video, so as always, remember that the information presented here should be used as a jumping off point for you to do further research into companies that interest you. The video doesn't cover anywhere near what's required to make good investment decisions on individual securities, and this video is only a summarization of my personal understandings and decisions to invest money into the companies mentioned within the video. I am not a financial advisor, I'm just a Canadian who likes investing and sharing my opinions with others. So I hope you found some value in this video, and if you did, please consider sharing it with someone else that might also find value in it. Thanks for watching and enjoy the rest of your day.